I'm Anthony West and I lead the investment committee here at Matthew Douglas. We're just going to go through the performance of the portfolios and some of the funds over Q1 2018 and for the past 12 months. So over Q1, the UK Top 100 Share Index was down over 7%. It's been quite a bumpy ride for 2018 so far, but volatility's come back, which is something that should be expected. The realistic portfolio, however, was down by about 4%, and our cautious portfolio was down by 2.7%. And we're pleased to see that those portfolios held up value, certainly in comparison to what we saw on the UK stock market. In terms of individual funds, we found that JP Morgan's Global Macro Opportunities Fund was up 1.92%, but unfortunately Royal London's UK Equity Income Fund was down over 6%. We were really pleased with the fixed interest element of our portfolios through Vanguard, Royal London and Keynes, as although these produced slightly negative returns, they were much better relative to the performance that we saw on the UK stock market. Over the past 12 months, we've seen that the UK Top 100 Share Index has gained over 8%. So again, with a bumpy ride to start to 2018, it still resulted in positive returns over the rolling 12-month period. In terms of the portfolios, we found that the realistic portfolio was up over 6% and our cautious portfolio was up over 5%. Although these returns aren't as high as the stock market, we're pleased that they have produced positive returns, which are certainly still in line with the risk profile, which is still meant to be lower than the stock market. In terms of the individual funds, the Jupiter European Fund led the way with over 18% returns, and this was closely followed by JP Morgan's Global Macro Opportunities Fund, which produced over 17%. Unfortunately, we had one negative performer, which was Neptune with the UK Mid Cap Fund, and this was down by about 0.5%. We've had the pleasure of hosting Mark Martin in the office, and he's been talking to us about the Neptune portfolio and what's happened to it over the past 12 months. He has a slightly more defensive view on UK equities, but does still feel that there are some good areas and companies to invest into. However, you have to be quite specific about what you're trying to invest. What this has meant for Neptune is that they hold quite a highly concentrated portfolio, but this is of stocks that they hold a high conviction in and think will be more defensive over the forthcoming periods. Past review, we've been looking into the exposure we have in Asia Pacific excluding Japan. So we currently use Stewart Investors Asia Pacific leaders in this area. Unfortunately, we've found over the last 12 months the fund's not performed in line with the peer group. Over Q1, the fund's defensive approach did help, with it producing a negative 4% return in comparison to Invesco Perpetual's 8% negative return. Although it was good to see this protection coming into effect, unfortunately it's been too long that we've seen low returns from Stewart Investors, and so we feel we need to be more efficient with the risk premium that we have in this area. In reviewing Asia Pacific, we looked at a number of funds, but from the pack, Old Mutual's Asia Pacific actually stood out as being the fund that interested us much more. The performance of the fund has been good in comparison to its risk profile, which isn't too different from what we're seeing on Stewart Investors. But the returns that they're getting have been much more efficient, and this is one of the reasons why we like this fund. The other reason why we like Old Mutual is because they have a strong belief that markets aren't efficient and that behavioural biases mean that there are opportunities for cheaper stocks to be purchased by their team. With this, they take 5 different valuation points on a company, and they'll use this in a dynamic way so that they can tweak what they effectively are buying and selling in the Asia Pacific region. The good thing with the fund is that it's style agnostic, and what this means is that they're not necessarily targeting growth opportunities or value opportunities, and can actually swing to wherever they see a total return being generated. Being that the Asia Pacific exposure is the smallest exposure of the portfolios, we want to take a higher element of risk, and as such we want the portfolio to generate a higher return. Old Mutual, we believe, has the discretion to move for where they see value, and we believe are going to be more efficient in making higher returns than what Stewart Investors have done in the past.